inflation came in over 9%, which was well ahead of what economists had expected, and largely fueled by energy and food, which of course, very important parts of everybody's budget. This is really what the Federal Reserve is raising rates to try to combat. So the more persistent inflation is, the more aggressive the Federal Reserve has to be. There was thought that they could raise rates 3/4 of a percentage points in the next couple of weeks. That's almost a near certainty. And so now the likelihood of ever higher rates, that impact on the economy, perhaps hurting the economy later, is really sent markets lower because we just don't know where the end of inflation really is. We're going into earnings season, and investors are a little bit jittery that with higher wages, higher energy prices, and potentially slowing demand, that's going to weigh on profits. It's going to weigh on margins. And right now, analysts, at least as a group, are still pretty optimistic. So I do think that there is somewhat of a mismatch between what analysts are expecting and what we're likely to hear over the next couple of weeks. And I think that's also an area of concern for the equity markets. Yeah, so there were recession talks going into this number. I think now the fact that the Fed has to be more aggressive in combating it means that the likelihood of recession is probably increased. Think about it this way: this is a cancer that the Federal Reserve is applying chemotherapy to, and the more chemicals we have to use, the worse things are off for the rest of the body. Unfortunately, monetary policy works with a lag. It's been thought that a rate hike or even a rate ease really isn't felt through the economy for another year or so. So just because the Fed started raising rates a few months ago in the face of higher inflation doesn't necessarily mean it'll ultimately have an impact. We are seeing, of course, impact in the housing market with higher mortgage rates. New automobiles sales are off a little bit. So there are parts around the rest of the economy, we'll call it the core, which is ex-food and energy, that appear to be behaving a little bit better. But most Americans don't spend ex-food and energy. Food and energy generally comes first. Going into this hike, a year ago or so, gasoline was about $2.50 a gallon, and now at $4.80 a gallon is meaningful, and that has a big impact. Just the price of food at home, which had been largely tame years and years, maybe picked up a little bit during the pandemic as everyone was ordering, cooking at home. But we're seeing escalations in the magnitude of 30%. So that's also having a meaningful impact on American households. So a lot of what we're seeing is really more of a supply constraint than it is demand driven. And the Fed obviously can't pump oil and they can't grow wheat. So all they can really do is impact the demand side of that supply demand equation.